be honest. But before we get into it, Peter, great to see you. How you doing
Hey,
today?
I'm doing well. Hopefully, I'm coming through loud and clear. And I agree. I mean, this type of strategy, we're not here to tell you this is the one to do, or here's exactly how it's going to, play out to your advantage. But I think knowing the common pitfalls, ways to kind of identify the opportunities that you're looking for when this strategy excels, and then potentially the opposite, when you might feel a little bit, maybe a little jaded and kind of that fear of missing out, or why did I do this in the first place? So no right or wrong answers. We're looking to discuss this strategy through and through as far as the fundamentals if you're newer to it, but then also kind of opening it up maybe to a bit of a sandbox or playground approach where we can actually get into maybe some symbols or kind of examples that you all might have on your mind, and then kind of walk through, the good, the bad, the ugly of this type of strategy. So if you do have some thoughts or examples, or maybe a common symbol that you want us to take a look at as a pure example or use case, feel free to drop that in the Q&A. We'll try to monitor that as much as we possibly can. But I'm with you. Let's have some fun. Let's talk about the details, but then also, I think more importantly, have some of those ins and outs discussed.
Yeah, absolutely. And I think that, as Peter said, this is geared towards you, right? We want to make sure this is as useful to you as possible. If you have a symbol you want us to take a look at, by all means, let us know because there's going to be a heavy amount of demonstration involved in this presentation. So if you have a symbol you're looking at or interested in looking at, let us know. But that being said, what we're going to be talking about today is, of course, selling options. So just a show of hands, how many people have heard, even before, maybe before they started options or after they started trading options, that options are, risky and you should avoid them. Don't mess with options, right? Yeah, I see a few hands for sure, and there could be some truth to that, right? Certainly when we talk about trading options, when we talk about buying options, well, our risk is limited to the premium that we pay, right? So if we buy a call or a put, whatever we pay for that call or put, that's our risk, right? We don't have anything beyond that. It gets tricky when we start selling options, but two different types of selling options here, right? So the things that we're going to be talking about are a lot different than just selling naked options. If you were to sell a naked call, that's the riskiest position out there because look, an underlying could go to whatever, right? You could sell a 100 call, and if you don't have the shares to support that call, and it goes up to 200, well, guess what? You're going to have to buy it at 200 and sell it back at 100 to whoever was looking for that stock. So naked calls are extremely risky. Naked puts, naked short puts are probably the second riskiest. The only reason they're not as risky as calls is because technically you can only go down to zero on that particular situation, right? But nonetheless, if you don't have something backing it up, it can definitely be very risky. So we're not going to be talking about that. What we're going to be talking about are two different things, really. Two different strategies you're probably very aware of with regards to selling, which would be cash secured puts or covered calls. And we're going to combine them to come up with a strategy here as we talk about the wheel. So let's go ahead and jump into it. Let's just talk about the first leg or the first element of this particular trade. So the first thing that we're going to be doing when we construct this wheel is we're looking to sell a cash secured put. And so what does that entail? Well, that's simply selling a put and setting aside that cash to make sure that you can cover that if you are assigned. So again, we don't know when we sell that put what the future is going to look like, right? We don't know what the outcome is going to be. We don't know if that is going to finish in or out of the money. When we are looking at a wheel strategy, what we're trying to do is we're trying to sell a put to get us into that position, right? In other words, we are actually hoping that we are going to go ahead and get assigned on this one because we want the stock. Now, how do you come to that level or decision as to what that might look like? That's going to be up to your own analysis. Maybe you're looking at a chart and you're looking at support and resistance, and you found a level of support that you think if it can get to that again, it might bounce off that. Maybe that's how you're looking at it. Maybe you're looking at a timing standpoint. Maybe you're looking to do it post or pre-earnings for that matter. However you decide to get to that point, that's going to be up to your analysis. But the idea is that we're going to sell that cash secured put, bring in that premium in the hopes that it ends up in the money and we actually get ourselves signed and we own that stock. Obviously, the perfect scenario would be if it went down and was in a place that we could buy it without having to put out too much different from the actual strike price. In other words, we'll go through an example, but hopefully it's going to be close to our strike price. But the whole goal is to put that money aside, hoping that we do receive enough, or hoping that we do eventually get assigned and we end up owning the stock. So the first part of this is going to be that cash secured put. And just a quick review of a cash secured put. Again, like it's an obligation to buy the stock at that strike up and until the expiration. Certainly from the standpoint of profit potential, it's just going to be one of those situations where we receive that premium and that would be the profit on it. But again, we're looking at it in slightly different light when we talk about the wheel strategy. Certainly there's substantial downside risk. Why is that? Well, yes, we're putting aside cash for the worst case scenario, but even if the worst case scenario happens, that's not going to be great for us, right? We're going to end up owning the stock and it could certainly go lower. So we do have that exposure once we get that position put on. So there is substantial downside risk. And of course, the amount of cash necessary to cover the obligation is required. That being said, let's kind of take a quick look at an example of how this might set up. So in this particular example, they're actually going to talk about doing a cash secured put outright, and we're going to kind of modify this to remember what our ultimate objective is, right? So in this situation, we've got 9,000 cash in the account, and QRS is trading at 92. This is a stock that we'd like to own, right? We would love to buy it if the stock price dips lower. So at this point, we're going to sell one QRS 90 put for $1, right? In other words, we're going to receive $100 and we'll have to deposit that $9,000 to cover the obligation. Now, the only difference here is you put in the difference, right? So if it's $9,000 obligation, you actually have to put in 8,900 because you do receive that 100 back. So that's the setup of that particular part of the trade. We've now gone and sold that 90 put. We've got our deposit ready to cover it. And let's take a look at what that might look like. So here we are, right? We've sold the 90 put. And if we take a look at right at 90, right? If everything goes forward and the stock expires right at 90, well, we get to keep our premium, but that put is now worth nothing. So we do get to keep that premium. We made $1 on this particular situation. If it continues to move up, well, that's going to be our profit, right? Maybe it didn't quite get to the level we were hoping for. It moves up and we end up with nothing on that particular position. So we received the premium. We didn't get the stock. So we could probably try it again at next expiration or whatever the time frame is you're looking at. If it starts to move lower, you'll notice now it moves down to 89. Well, we get that premium still. The put value is actually worth a negative $1. So that's our break even, right? Anything that we do here with regards to selling this put, we take that strike price, we subtract the premium, and that's our break even. So 90 minus 189. That's our break even. So what's the ideal situation in the wheel strategy? Remember that if you have an option that is 1 penny in the money, that will get you assigned, right? So in other words, if we start to see this thing move below 90, but maybe even stay above 89, that's probably going to be a pretty good scenario for us, right? We didn't quite get all the way down to the break even. If we got down to 89, that would be our break even. So we didn't make money on the trade, but we would own the stock at that point. The issue is if we continue to go lower, right? If we start to go down to 85, well, yes, we'll own the stock, but we're going to own it at 90 or technically 89 because we get to keep that $1 premium. And we're going to be out of the money on this particular situation to start with. So that is a downside on this particular strategy, right? If we can time it perfectly and we can end up in between 89 and 90, that would be great. Oftentimes that's not the case, right? And so there are situations where it could go through that and you may own it a bit higher than where the current market is. But again, the goal here in the wheel strategy is to get that stock on the books so that you can do the next leg of the trade, which is that covered call. So let me stop there for just a moment. Hopefully that's making sense to you so far. Peter, anything you want to add to this before we start moving forward with anything I missed that might help in the explanation here?
No, I don't think anything that you missed at all. I think maybe a couple things that I would reinforce or just echo is looking at what that profit or loss is going to be. Folks, do keep in mind when we're talking about these credit types of strategies, the maximum gain potential or that credit that you are receiving, yeah, that's as good as it gets. So whenever you are putting up that type of capital, therein lies the name, that cash secured put or cash covered put. you're earmarking some of those balances. So that's why when we talk about this type of trade or structure, you got to think about the opportunity cost. And this example, of course, is that dollar profit for selling that $90 put, is that going to be worth it to you or not? Obviously, this is a stagnant example that we've got here, and that will differ on a number of different positions that you are going to be looking at there. So I think that's always what comes to mind for me, Albert. In low interest rate environments, we would see these types of strategies pretty often because folks are thinking, hey, I'm getting nothing on my cash. It's just sitting there. I'd be okay maybe selling some cash covered puts in order to go ahead and try to generate some additional or extra income. This day and age is a little bit different, but of course, you'll find that oftentimes that's going to make its way into options premiums anyway. So just do keep those types of concepts in mind. But as far as cash secured, puts go, I think that's at least a great way to go ahead and set the table for that type of strategy. Like you mentioned on the wheel strategy, a fancy way of what we're talking about. It's really nothing more than doing what Albert has described so far. And then if when you are put these shares, now you've got the shares in your account, what are you looking to do? Well, at least via this strategy, potentially you'd be kind of doing the other side of the spectrum here and actually now selling covered calls. So in this pure example, if the stock price was to be drifting lower, like Albert had said, maybe somewhere between 90, 89, that'd almost be your best case scenario. I'll transition over to covered calls. Just do keep in mind the risk here of this type of strategy. As we had said, I don't want to belabor the fact, but everybody I feel like, or at least a majority of clients had always said, okay, well, the credit's great. It's almost like a limit order I'm getting paid for. Do keep in mind, however, with a limit order, overnight, maybe you've got to buy at 89 bucks. All of a sudden stock opens up at 80. Well, with that limit order, you can go ahead and cancel that order before it fills, as long as you see it maybe gap down overnight, kind of on a situation like we're seeing here and now today. With these options, however, you might actually, of course, not have the ability to go ahead and close that, might be facing some losses. So that's, I think, the biggest concern with the cash covered put is the credit that you're receiving going to get really vaporized if there's a large unexpected downward move in the stock position. So do keep that in mind as far as that strategy goes.
And then
Let
one
me
last thing before you move on,
go
Peter,
ahead,
I just want to
please.
say, with these puts, remember again, keep in mind that the goal here is to get the stock, right? You want it to get assigned. So the best scenario for you is that keeping in mind that you will automatically get exercised or assigned if it goes 1 penny in the money. So what is 1 penny in the money? Well, that's 89.99. So if this thing ended up at 89.99, you'd make a 99-cent profit on the put and you get the stock and you can, pretty close to where it was actually the strike price. So that would be the ultimate scenario. But again, hopefully it stays between 89 and 89.99 to get you set up for the next leg, which is what Peter's going to talk about now.
Oh, exactly. And that's a good point too. That is it will, in theory, it's going to be reducing that break even point, or at least the cost of the capital that you have if you were otherwise buying that stock outright in the open market. So could you buy those shares at 90? Yeah, absolutely. Your cost basis is going to be that 90 bucks. By collecting this dollar, you're effectively lowering that cost basis that you've got, or lowering that break even down to $89, in this example. So that's a great add-on to that, Albert. And that's part of what we're thinking about from, what did I say? Kind of in that intro, Albert, when you kicked it over to me for a moment, I was saying, when this type of strategy excels, and I think what we'll see here with this, covered call strategy is somewhat similar. When did this strategy excel, folks? Well, it's when the stock price is moving higher, clearly, or if it's somewhat neutral or range bound, kind of in that $90 price point. 89 bucks is where you're breaking even. Now, if you had wanted to buy the shares and it moves much, much higher to 95 or 100, well, you're still at your maximum credit profit potential there. Although, if your main goal was actually to be a holder of those shares long, well, now maybe you've missed out on what is just that opportunity cost towards the upside had you actually just bought the shares in the first place. So, some give and take, right, as far as the different strategies are concerned. And that's the big emphasis that we want to put, is that being a credit or options trader or taking in some type of credit, that's going to give you additional cushion or additional padding. Although, given the fact that you're taking on some type of obligation, well, maybe there's going to be a little bit of that, I guess, missed potential. Just keep in mind that is that opportunity cost that on the forefront of this trade, you need to be ready and willing to really forego in order to go ahead and kind of put that credit in your pocket here and now. So let's walk through a covered call strategy for those of you that might not be as familiar with this strategy. Carrying on what Albert had said, we had sold that put. We had the cash in our account. Those shares, let's just for instance say, got assigned. Now we're the holder of whatever that company might be, company XYZ. We're a buyer of those shares. Now that we own those shares, our thought process might be that we want to go ahead and actually sell calls on that share for share basis. And this is what makes this a covered call rather than what Albert had described earlier as a naked call, meaning that you don't have those shares if the event of assignment takes place. Worst case scenario, if you were to sell a covered call, if they get assigned, well, they're going to come and take those shares that you own in your account rather than you having to go in the open market and buy them at whatever the going rate is at that point in time. So that's why covered call essentially is seen as a, I guess, less risky style of approach. But I say that kind of tongue in cheek because do keep in mind, if you are holding the shares, and of course, we are selling those calls against it. Well, we're going to go ahead and take in a credit, but of course, we're still owning those shares. So if the stock price was to decline severely, now you still own those shares. That credit you took in might cushion some of the blow, somewhat like we had seen with the selling of the puts. However, there's going to be that break-even point embedded, which we're going to take a look at here in just a moment. But the nuts and bolts of this strategy are that you are going to go ahead and receive that premium, and in exchange for that credit, in exchange for that premium, you are then going to be selling your shares if the counterparty to your trade comes calling for them. Now, that's that entire downside is what I had already referred to, and that's the fact that if you are owning those shares and you're taking in the credit, well, if you own shares themselves, the credit premium helps cushion that blow. But if some catastrophic news comes out, that stock is down 10, 20, 30, 40, 50%, who knows what that number might be, you still do own those shares in your account, which are going to be detrimental to your portfolio. Upside potential, like I pointed out with that covered put strategy, is limited to the premium that you receive. And I say that let's take a look at it maybe a couple different ways. So from the option position, of course, the credit you're receiving, that's the most that you can, I guess, make on that option itself is the credit. Now, let's say that you maybe had shares at $90 and you sold a $95 call against it. Well, of course, you're going to get that premium for selling the 95. And there's also the chance for you to have a bit of that capital appreciation, say from the $90 cost basis that you are owning those shares at, all the way up to that 95 short strike in that pure example that I had. So there's a little bit of the potential for maybe some capital appreciation from where you're holding your shares at now up to that strike, plus that premium that you're receiving. And that gets into a bit of the nuance also. Do you want to, as a covered call writer, sell something that's at the money, maybe slightly in the money and actually generate a higher credit? Well, if you do that, you're going to be foregoing some of that potential for upside potential, some of that potential for capital appreciation. And of course, the other side of that, to play devil's advocate, is if you own shares and sell a covered call that's far, far out of the money, well, sure, you're getting a bit of a credit, you're getting a little premium, but is that premium worth it? Should that stock price increase far, far and above maybe what your expectations were? Maybe it's that scenario where you own shares at 90, you sold a $100 call thinking that'll never happen. You pocketed 20, 30, 40, 50 cents, whatever that number might be. Lo and behold, the stock does what? Well, maybe it runs up to 105, 110. Well, like Albert said with his put scenario, if your shares get taken in a covered call, that in reality is your maximum gain. However, maybe the kind of fear of missing out that upside potential might negate the thought that you want to be doing this strategy too often. So a lot of this comes back to your outlook. and your outlook needs to, if you're going to be putting these covered calls on, especially covered calls that are maybe closer to the money, neutral to moderately bullish on the stock. And that is the reason being, you're going to be able to take in that credit, increase your income by the amount of that premium that we talked about. And what that will do in turn is going to be slightly reduce that stock price risk that you have. And that kind of goes back to our table, which we'll take a look at. Thought processes. If you take in a bit of a credit, maybe even just $1, let's say, on those shares of stock at 92 bucks, well, what have we done? Well, effectively, we're kind of chipping away at what that original investment cost us. So let's look at this scenario, and then we'll look at a table, which will hopefully speak volumes to this. Long 100 shares of QR stock at 92, neutral to moderately bullish. We're looking for maybe a slightly rising stock price environment. So you're thinking, well, I'll go $3 out and sell the 95 call and collect $1 for that. So $3 potential for capital appreciation from that 92 up to 95. And the maybe icing on the cake is that extra dollar that you're taking in from selling that call. Now, here's that table, very familiar to what Albert had shown. And hopefully some of you that are even just glancing at this for a moment or two are seeing some similar characteristics when it comes to what your maybe maximum gain versus maximum losses are. Similar structure there. Substantial losses towards the downside in a falling stock price environment, and your gains or profits are going to be capped at some point or some line in the sand, depending on that strike that you're selecting. So on this case scenario, if you are looking at, well, if you're long shares at 92, we took in that buck, what'd we say? What's the benefit? Well, a little bit of a benefit is that you're able to reduce your break even by that dollar. So now all in all, you're kind of in the stock for $91. So even if this moves against you by that dollar or roughly a percent or so, well, hey, no harm, no foul. You're still at break even. That's kind of that neutral environment that we're talking about. Now, from the slightly bullish, let's say that this does work out very well, moves its way up from the 92 that you bought it at to that 95 bucks. Well, you took in $1 from selling the 95. You took in $3 of that capital appreciation from 92 up to 95. 3 plus 1, giving you a $4 gain. Whereas if you had just bought the stock, you've only got that $3 gain. And oh, hey, by the way, you don't have that dollar break even or dollar, I guess, drawdown potential to still be breaking even on the downside. So that is kind of the sweet spot for this type of trade, is that if it's neutral to slightly bullish, you've given yourself a little bit of downside protection just in the form of the credit premium you're taking in. I really hate to use that terminology as far as covered calls giving you downside protection. It's really just kind of a silver lining, so to speak, should that trade go against you. And that's just to the tune of the premium that you're receiving. So make no mistake, folks, covered calls really should not be thought of as a hedging strategy in any way, shape, or form. Definitely not above and beyond the premium that you're taking in, which is why I kind of use that caution. If you are thinking that a stock you're owning is going to be going down, you're going to be better served by looking at other strategies aside from a covered call, and definitely a covered call that's out of the money. Now, when does this strategy start to really not make sense or kind of go against us? Well, one, let's look at the obvious towards the downside. Sure, that dollar helped us out, reduced that break even from 92 down to 91. Maybe it drifts down to 90. You're still not feeling so bad. The pain point comes in from that sharper directional move, maybe than you had expected, 85, 80. Now, if I asked you, would you rather have a $7 loss or a $6 loss? Or would you rather have a $12 loss or an $11 loss? I think it's pretty easy to see. Everyone in the audience is going to raise their hand for having a lower loss on their hands. Although, if you were truly feeling like this was within the realm of possibility, as I mentioned before, there's probably a strategy that will serve you better than either of these losses, given the fact that you're just taking in that dollar premium in the first place. The other time that the strategy might hurt, not necessarily from how your net worth or portfolio totals are going to look, is kind of that moonshot. Let's say that you were thinking that you were going to call it really great. You thought maybe in the interim that you were selling this call, it was going to drift up to 95. Maybe you keep your shares, maybe you buy some new ones and do it all over again. And then next month, whatever the time frame might be, it drifts up to 100. Well, if in the time frame that you had sold this, it drifts up to 100 or 105, 110, now your short call is going to begin to kind of erode or evaporate or one for one offset some of the gain potential that your underlying shares could have had. That's a lot of woulda, couldas towards the upside. Albert, I've seen in my day lots of these upside potentials where clients felt like they really missed out on a major move upwards. I've seen that almost be more mentally challenging than the positions that look like this, where the stock position went down. They've lost more money, but they got to keep that credit. Folks, if you're doing this strategy, don't put the cart before the horse. You want to make sure that you're doing this strategy in order to go ahead and have that outlook expressed as a means to be able to try to exit your position with a little bit of that icing on the cake and a slightly I guess, cushioned neutral to slightly pull back in the stock, but not necessarily that you want these credits to go ahead and be your max gain. Best case scenario is that neutral to moderately bullish environment. It's more or less what this profit loss diagram shows us. This line just showing that we are reducing our break even. And then, of course, this green hockey stick up here showing us that, yes, our actual gains are going to be capped. And that is evident by that 95 short strike plus the dollar in premium that we took with our break even there essentially at that $96 price point. I know there were some maybe questions that were coming through here real quick, Albert, and then I'll open it up to you for a moment for your thoughts on covered calls as well, or kind of riding this, seesaw or teeter totter, whichever part of the nation you're in, back and forth on selling the puts, maybe getting put positions, selling covered calls, maybe having your shares taken from you. Is how to manage this. Well, you can either buy to close. You can roll this, kind of kick the can down the road, or just let it expire. And that letting it expire might be that your directional view has changed, or maybe, like we had said, you really want those shares to get taken. You're perfectly fine with what that kind of quote unquote max gain situation was going to be. And then you either want to reassess the situation on that specific symbol, or maybe you're looking for other opportunities in a completely different tradable product. All right, let me pause there. Albert, thoughts on covered calls or any questions that we wanted to address very quickly here? Compare, contrast those two.
Yeah, a great point was made, or a great question was asked by Wally, and hopefully I'm pronouncing your name correctly. But the question was, cash secured puts and covered calls are basically neutral to moderately bullish. Yes, that is true, right? If you were really bullish, there's definitely better choices out there that you could be doing with regards to taking a position. But the goal here, again, in the wheel strategy is to get the stock into your account, and then to be able to sell covered calls against it. Now, that might be your strategy, as Peter said. You might be looking at just using the wheel strategy to simply get yourself into a trade and get out of a trade. That's definitely possible. Certainly, that's a little bit different than using a secured put to get into a trade and then being bullish and just kind of hanging on to it, right? So that make that distinction here right away. When we're talking about the wheel strategy, we're combining two strategies that are basically neutral to moderately bullish. So if that's the case, right? Maybe we're looking at something that's in a range. Maybe we think there's something that's got limited upside potential, but we think that it could bounce off of maybe a resistance level, for example, right? And so that's the kind of thing that we're taking into account when we look at these types of trades. So let's take I think probably a good idea to take a look at an example here, Peter. And again, if you have any symbols you want to take a look at, let us know. We're happy to do so, right? We want to make sure this is as useful to you as possible. In the meantime, I'll just start with one that I think probably is relatively popular, which would be Microsoft. I think probably everyone knows that particular name, and this would be a great place to start. So let's just say that we're looking at Microsoft today, and we've noticed that we've got this pullback. Now, again, the way you come to your conclusions as to what you want to use, that's entirely up to you, right? That you might have a specific strategy, you might have technical analysis, whatever it may be, to find that point that you think is a good entry point. That's what we're going to use. So for me, maybe I'll look at this and say, you know what? If I take a look at where Microsoft is currently, and I'm going to draw a little bit of an area right here that I think is a bit of interest for me right here, right? So it seems like there's been some activity right here at this particular level. It looked like it was a bit of a resistance, and then maybe it pops back out somewhere in this 425, 430-ish range. And now I also am taking a look and saying, well, you know what? This is also below its 20, but the 50 is right here at 436. So I think that somewhere in this 430, 435 range might be an opportunity for it to bounce, because I know that in theory, right? In theory, when a particular level of resistance is broken through, it tends to act as a support. So my theory is that, hey, somewhere around 430, around its 50-day moving average, around the top of this part of this zone, it should find some support. So I'm going to say if it gets to 430, I'd like to get involved in this particular stock because I do think that Microsoft, has a bit of room on the upside. I don't think it's going to go a lot lower. I think it could stay in a bit of a range. I'm not looking for it to blast off and move to 500, so I wouldn't mind owning it at 430. So that's the kind of the starting point. Again, however you come up with that analysis, that's entirely up to you. I'm just giving you an example of how you look at a moving average. You might look at some technical analysis to come up with those particular levels. So I'm just going to say, all right, well, I'm going to be looking at 430 as a level that is interest to me. Now, the next step is, well, where do you want to do that at, right? What type of time frame are you talking about? I just pulled up September, but we can look at a couple of different scenarios. Few things I do want to point out, right? The first thing I want to point out is this right here. They've got earnings on the 30th, which is, less than 2 weeks away. Those earnings can be a binary event, right? It could either be really great or really bad. And so therefore you want to make sure you take that in consideration. So it's pretty timely that we're actually having this conversation right now as we head into the earnings season right now, because again, we don't know what's going to happen with Microsoft and earnings. In fact, let's take a look at a couple of examples of what may have happened on earnings. You can see there's been opportunities for it to have some pretty big moves, right? Here you can see earnings and got a pretty big move up, but then it kind of didn't hold and came back down. Here we saw earnings maybe move the stock down, which soon recovered. So there's some volatility around earnings, right? And so therefore, if you are putting out an option strategy ahead of earnings, just be aware of that. Understand that there could be some volatility, and it might end up in your favor, right? It might give you an opportunity to maybe get the stock quickly and then watch it move up after the fact, or it might work against you, right? You can certainly see a scenario where you're owning the stock and it comes back down, and then you get frustrated, get out, and next thing you know, it takes off. So just be aware that earnings can make the entire situation very tricky to navigate. But for the time being, let's just assume, again, that we're not talking about earnings. We're just looking at Microsoft in general. Well, we can look at a variety of different things here. So I'm just going to say, look, I want to avoid the earnings. I'm just going to go and take a look at the 26th real quick, just to kind of see what that might look like. And I can go right away to the 26th, and I can actually move this out to 20 strikes. And so the 430, the 432 and a half, I can see that it's about $2 and about 250 for the 432 and a half. So I don't want to mess around with earnings, but I wouldn't mind owning it ahead of earnings because I think that maybe earnings are going to be a big, kind of a nothing burger and maybe move it a little bit higher, but I'm not afraid to own it ahead of earnings. So I might look at this 430 and say, you know what, I'm going to sell this cash secured put at $2. And if it gets to below that before the 26th, then I'll own the stock, and that would be my preferable situation, right? I'd like to have the stock on my books and go ahead and own it at that price at 430. If not, then I get to keep that premium of $2 and try again. Why do we want to use? I guess what factors do we take into consideration when we decide what expiration to use? I think probably the biggest one is beyond the idea of what our time frame is. We think the move could happen. The other part is options are a decaying asset, right? And when we get inside that 60-day window, inside that 45-day window, that time decay starts to accelerate a lot quicker than it normally would be. So in other words, we kind of see the time decay kind of come down linearly, but when it starts to get towards the end, then it gets more of a logarithmic kind of move and it starts to accelerate quite quickly. So if our goal is to sell an option and retain that premium, certainly inside that 60-day time window, 45-day time window really would be optimal. Now, again, this is a scenario we're trying to actually own the stock. So I'm going to say that for us, we're actually hoping that we're not really as concerned about the keeping of the premium. We're trying to get the stock onto our books. So how can we go about doing that? Well, we can certainly choose an expiration that we think is, maybe a little bit closer, and hopefully we see some movement in that shorter period of time. We can certainly go ahead and look at something that's in the money as well, right? For example, we could maybe even say, well, 443, I could sell the 445, and knowing that at this point, I have a greater chance of it staying in the money based on where it's at currently, right? We could definitely do that and collect that premium. But again, whatever we decide to do, right? we have to understand what our break even looks like when we actually do this trade. So in other words, if we were to sell, say, the 445 for $7, we know that it could go down to what, 438, right? So 445 minus 7, 438 is our break even. Well, if we take a look at our chart, we decided that 430 was really kind of the level we were looking at. And if it gets below that, then maybe it's got some room to run. But our analysis is somewhere in that 430 range. So do we really want to own it at 438? Well, that's something we have to decide, right? We have to decide what is more important for us. Is it getting the stock on the books or getting it on at the right price? And I think that's kind of where you have to start with the strategy. Understanding getting the stock on the books is one thing, but getting it on at the right price is certainly another part altogether. And hopefully that's a bit more important for you. Any thoughts on that part, Peter, as far as like how you want to execute this beginning part of the trade or choose expiration or strikes?
Yeah, I completely agree. I think that gets back to your mentality as to do you truly want to use this as your entry, I suppose, and thinking about that premium that you're taking in as I hate to say discount. I know that that word gets thrown around a lot from the community of kind of a, well, if I sell the put, I've kind of got a discount on the shares. I mean, keep in mind, if you're looking to actually own those shares, as Albert had walked us through, and I can pull up an example here. You were on Microsoft. I don't mean to flip the script, but I know another symbol that actually came through was NVIDIA from Danny. And I mean, this is a position that moves around quite a bit, right? There's a lot of narrative to this position as potentially one of the most important in the marketplace, but that's really neither here nor there. The dynamics are going to be very, very similar on that cash covered put, perspective. If you are using cash cover puts as kind of an entry strategy, like Albert had mentioned. Okay, I mean, if you're looking for this to happen and you want these shares over the weekend, you're using cash cover puts to do that. First things first, look at these deltas, folks. Delta, one of those Greeks that classically, if you open a book, says, okay, well, for every dollar the stock moves, my option is going to gain or lose value by the amount of its delta. A couple other ways that you could also view delta as maybe a gauge of the likelihood that that position or that option series will be in the money at expiration. Shorthand, mental traders, I can speak for at least myself. Don't want to throw you in that camp, Albert. Back of the hand math, back of the napkin is something that can help out, right? Take some of that mental fatigue off of your plate. Well, traders will look at this and say, okay, about a 76 delta, maybe a 76% chance that these 123 puts in the money with the stock trading at 118 over just the course of those next couple days. Now, obviously, this position's moved quite a bit, right? We're talking a 6% move, $8. What I'm really drawing at is if you wanted to use this in terms of being able to give yourself a high likelihood of getting the shares, and you're looking at maybe selling these 5.25, come here to this menu. You can see the view bid analytics. If you are selling to open this strategy, you in theory be taking that bid price or collecting that, so to speak. So your max gain, obviously the credit, if you sold that, collected 525, position goes up. Well, at least you got to keep that credit. If it at least stays where it is or potentially lower than that 123, your break even is about 117.75. So kind of a way to get into the stock with a quote unquote maybe discount. I mean, sure, you're talking maybe 70 cents or so as so far as where that break even point would be. And there's still that maximum loss as substantial. Now, if you are thinking about maybe going further out, not just 2 days, but potentially 2 weeks or maybe even a full month, those dynamics are going to change as far as the kind of time premium that's going to be built in there. Now, if you're looking at those contracts, viewing those analytics, well, now your break even is lower by a couple bucks because there's more time to play out, more uncertainty there, and it's reducing that break even point. So I think you want to ask yourself, there's going to be that. The way I describe options is kind of a spectrum. Where do you fall? Is it essentially with not a lot of time to, expiration? Is there a tremendous amount of time to expiration? Is there maybe some type of binary event like earnings? That's going to, dictate the premium that you are going to be receiving for the actual stock price itself. But once again, keep in mind, oftentimes a juicy or maybe implied volatility can be enticing. Take the counter argument. If you don't want to be put those shares, try to keep in mind I don't want to say get too cute with it, but if you are selling, let me just say this, if you're selling a in the money put, that is going to be essentially the most bullish type of environment. If you're selling that out of the money put, well, that's when you're more neutral to slightly bullish. And even if it retraces by a few bucks, you still have a bit of that directional move before you begin to get here. So, as a pure example, if you're looking at the August 16th down at 117, look at those bid analytics. Well, what do we have here? Your break even now down at 111. So that's what I mean by how bullish do you want to be? Sure, I think utilizing them as a means to either generate a higher credit by going deeper in the money increases your likelihood of getting put those shares or assigned. But do keep in mind you are also going to have more intrinsic value that you're reaping the rewards of, potentially less time premium or less extrinsic value. And it's also going to be different as far as your break evens are concerned. Here, max gain about 590 and your break even down at 111. Whereas in contrast, if you were to look at, let's say, the 121 contracts, and you're looking at the amount that you are collecting, well, 800 max gain, but a $2 higher break even. So not a perfect, I guess, answer. And I don't think that there is one. I think the answer really comes down to what your outlook is. Do you feel like this position is one that's going to, kind of hang around, maybe find some support here at about 118, maybe drift back higher, at least maybe close this gap up to 124. Maybe that's your neutral to slightly bullish trade thesis? Or is it something where you feel like, if it breaks this line in the sand, maybe 108 is our next stop, and maybe that's where I see some support. So potentially selling something like that, 110, 111 out of the money, and then reducing that break even. That way, if it does falter here, potentially you're getting put shares down at about 115, 111, whatever that number is, then having a little lower break even where you're then seeing some support. Now, I don't know what's going to happen, which is why I don't think I've got the answers as to this is the call that you should sell against shares you own, or this is the put that you should, sell if you're looking to get put shares. Hindsight's going to be 2020. There was probably a lot of put sellers here that made out like bandits for a day or two, and then maybe they felt terrible a couple days later when it drifted back down lower. And then maybe they felt great all but about a week ago. And now, how are they feeling? So I think that also gets back to the management standpoint. Are you managing a trade through passage of time? Whereas a seller, you've got that time decay on your side. Is it a directional move to where now the gains that you have as the stock price as a put seller are decreasing, the higher and higher the stock price is going, versus maybe some of those losses accelerating the lower and lower that stock might go. And I think that's the other reason that you do want to be mindful of your deltas and how that can change if you're going further out in time for something like 30 days versus something maybe that's only got a week in its lifetime. Those deltas, given gamma's effect, are of course going to ramp up very, very quickly, one direction or the other, especially when you have some volatile days like today. Let me pause for a moment, Albert, if there's anything else you wanted to piggyback on there. I know that's a lot of time spent on the, cash covered puts. I'm happy to look at, covered call scenario, but I think the benefit, or if you're kind of reading between the lines here, back to that options chain, if you're thinking about the cash covered put we just discussed, well, what we say? We said, okay, well, I'm going to reduce my break even. And if I get put these shares at 118, maybe my break even is going to be down, around 112 or 111 and change, something like that. Similar thought process. If you're ponying out the money at 118, but then you're collecting $7, what's your break even on that, folks? It's pretty much going to be exactly the same. The bid analytics is a bit different, but if you come to trade strategy and then buy right, hopefully that fills in some of that for you. And then you can see break even very, very similar. The biggest difference between that covered call is that you actually already own those shares. Maybe you're entitled to a dividend or something of that nature. Maybe you like to vote on your shares, whatever that might be. And then you've got the obligation to sell them away if somebody comes calling. versus in this scenario with a cash covered put, you've got the cash waiting idly by in case someone assigns you those shares, at which time you, of course, go ahead and change that cash into shares that you're then owning long term, less that premium offset that you had to reduce that cost basis. I think we're doing good on time, Albert. 15 minutes left. Let me pause there for a moment. Any thoughts you had? We've got other tools that we can show. I'm up for other symbols, other examples. I know Walid was responding to you there. Thoughts you've got here, dealer's choice.
Yeah, I think this is actually, NVIDIA is a nice one to kind of stick with. I think we can definitely look at something here. And the thing to remember about NVIDIA is that if you were doing this strategy, let's just say all year long, right? And maybe started doing it at the beginning of the year, um, you know, probably through the first quarter, you ended up just keeping premiums, right? If you were selling puts on this thing, it just kind of kept going the opposite direction. Maybe you got an opportunity right here, but for the most part, right, you're just keeping that premium. Now this is kind of what I was talking about before, and that is that if you're actually bullish the stock, there's better choices, right? Because if you're selling a put into this, and you feel like your mind think this is a possibility, then wouldn't you rather just be long the stock or long a call as opposed to just selling puts? Yes, they'll expire worthless. You'll get to keep that premium, but there's probably better opportunities out there. But let's take this example, right? Let's just kind of stick with this for a moment and kind of talk through how this might look if we were in this wheel strategy. Let's say that we saw this stock NVIDIA trade down to this level here. This again, what is it? Roughly 120, we'll call it. And we decided that as it starts to move up again, getting to this level, we said, you know what? There's a good chance that maybe this thing retraces a bit and goes back down to that particular level, getting back down to 120. I feel like that might be a good range. I'm looking back over here. I'm seeing that 120 has got some pretty good interaction. We're currently trading at 134. You know what? I'm going to sell that 120 put, and I'm going to try to, wheel into this thing. Well, fast forward to where we are today, of course. Now let's say that maybe you got the expiration. What is today? The probably let's just say you get a sign on this thing, and now you own the stock at whatever the price may be, 120 less any premium that you actually receive for that. And so now your next step is to try and sell a cover call for this, right? Now, again, this is going to come down to your bit of timing, what you think probably is an appropriate time frame with regards to when you want to actually do that. Again, NVIDIA is a late reporter, so their earnings are going to be a little bit later than some of the other ones. But maybe let's just say you're kind of hoping to maybe get rid of it prior to that. So we'll talk about August 16th. So now you own the stock. You've owned it for something less than you own it at 120 technically, but something less than that because of the premium you received. And now you're thinking to yourself, okay, I think that this thing could probably get before earnings at least could get back up into this 135-ish area potentially, right? That's kind of what I'm thinking. The other way you can do this is if you were to go to options and probability calculator. And I think this is a useful tool whenever you're looking at covered calls, just because you get an opportunity to kind of visualize where things could be. Now, all this is the probability calculator is basically taking that standard deviation curve, and you can see it's set for 3. I'll change it just to 1 to make it even easier for us. But all this is doing is taking the current level of volatility and projecting it forward to let you know what things could look like. So again, we were looking at an expiration of August 20th, I believe, was the expiration we were talking about. Yeah, August 16th, excuse me, August 16th. So the nice thing about this particular tool is it gives you the ability to manipulate the 3 main elements when you're dealing with options. And what is that? It's the underlying, of course, time expiration, the volatility levels. When we talk about buying a stock, it's pretty straightforward, right? It's buy and it either goes up or down. Options, there's more components to it because we've got that time expiration as well as that volatility. And so this gives you the ability to adjust those 3 factors on this probability calculator. So again, I'm going to say the date, I'm going to change this date to our expiration date, which is 8/16. And I'm going to take a look and see if I can figure out where this thing might be at that point in time. In fact, I'm going to add a second number here just for simplicity's sake. And now I've got these 2 sliders that we can work with. So what I want to do is I basically want to take this to the edge of where this probability bubble is, so to speak, right? And take this one to the other edge. So now that what this is telling me right now is that by August 16th, based on the current level of volatility, there's a 68% chance that it's going to be somewhere between 136 and a half roughly and call it 100 or 101, right? There's a 68% chance it's going to be inside of this window. So of course I'm concerned now because I own the stock, but I'm talking about the upside. So if I'm looking at this and thinking, okay, there's a 68% chance. Really, if we take an even wider scope here, if there's an 84% chance it's going to be below 136. Now, again, if you're trying to actually get the stock sold, that's going to make a difference for you, right? Maybe you want to choose something inside of 136. If you're hoping to maybe hang on to the stock, then maybe you want to choose something outside of 136. But again, the wheel strategy, the whole idea is to get the stock on the books and then use a covered call to sell it back out. So under that assumption, I'm looking at a video saying, okay, where the current volatility is heading into earnings, there's a 84% chance it's going to be below 136 and a half. All right. Now, armed with that knowledge, I'm going to go back to my option chain. I'm going to take a look. Okay. Well, August 16th, what do I want to look for? Well, what I want to look for is something that's going to be inside of that 136 and a half range. So I'll scroll back down. By the way, this is why you got to be careful loading all strikes because it can take forever to load. All right, so now I can look and see, all right, here are my options. I've got a 136, 135, 134. Now I have to decide, is this worth it, right? I'm going to collect, a little over $2 for the 134, close to $2 for the 135, and then it goes, of course, lower beyond that. Now, the question you have to ask yourself is, is that worth it for you? Is it worth the $2 to sell that call? So again, in this scenario, we're hoping to get the stock called away from us because it's the wheel strategy. We're using the put to get into it. We're using the call to get out of it. And if you go back to our main chart here, so maybe we've got some analysis. We're thinking, all right, I think there's a good chance it could get to somewhere back up to this range of call it 35, 36. So yeah, you know what? I think that for me, there's enough appreciation at that point. Remember, you own it from let's 120 less that premium. So let's just say you own it for somewhere at 110 roughly. If it gets to 130 and 135, you're still going to make $25 on the stock. Plus, you get to keep that extra $2. So this might be, for you, that might be the choice, right? Like saying to yourself, look, I can sell this 135 call. I can bring in almost $2 for that particular call. And quite frankly, if it gets to, 135 or 136 and it gets called away from me, I'm okay. I've made essentially, money on the stock, the $15 on the stock, plus I've made whatever premium I got for selling the put. Let's just call it something crazy like $10. And then I've made another $2 selling the call. So that's kind of the idea with the wheel strategy. The wheel strategy is saying, look, I think this particular stock has a range over a certain period of time. I want to get into it for a decent price, and I, certainly can get paid to do so, as opposed to putting in a limit order and saying, "Hey, buy this out down here at 120." I sell that 120 put, and I get this exercise and now or assigned on it, and now I long it from 120. I get to keep the premium from what I did with the put originally selling it, and now I want to get out of the stock. Uh, because I don't think it has tremendous upside. I think it's going to be in a range, but I want to get paid to do that too. And so you sell the call, you bring in that premium, and you hope that at some point it gets ideally it would get right to just above the strike, so you're not missing out on too much upside. But either way, you're looking to get the stock off your books at a profit. So that in a nutshell is what the wheel strategy tries to do. It takes these two relatively neutral to slightly bearish strategies as ways to get into a stock, but also generate some income, and also to get out of it and generate income, right? Because we could, right, Peter, we could just set a limit price and say, look, if it gets down to 120, buy it for me. But the whole idea is that we're actually going to receive premium to do that, to get into the trade. Now, the difference being is if the stock got down to close to 120 and we didn't actually want it, we could just cancel a limit order. A put, we'd actually have to close it out, so it might cost us to do so. But nonetheless, keeping in mind that the overall goal here for the wheel is to get into the stock and get out of it using options. So I'm probably missed a few things. I'm sure you've got some things to add, Peter. What are your thoughts on that?
No, I think that's the point here, folks, is that you're having some type of a directional outlook. You're being able to try to apply that. You're looking to, if position was to move in your favor, maybe you'd be a seller there anyways. And getting into, covered call, just this NVIDIA example, like you're mentioning, if it was able to go ahead and get back to 135, the way that the Greeks are going to be changing, especially for those deltas, you might start off by selling to open that 135 call further out in the future. And then the dynamics would be that, well, those deltas are going to be increasing. Another way, I guess the third way, or at least the other more common way delta could be seen is, kind of a stock price, or excuse me, a stock share equivalent, so to speak. So those deltas might start on those 135s that you were showing at a lower figure. But if when the price of the stock was to move higher, those 135s deltas might be growing. Now, what that means is that's going to be offsetting a little bit of that, I guess, potential gain that you would have on the underlying shares. But the beauty is, if that was your kind of sale target, so to speak, you're fine. If those shares to get taken at 135, actually, you're happy because that was your target, and you're able to go ahead and increase that sale target by collecting that additional premium, like you were saying. If you want to model this, because I know we're starting to get closer to time, a brief example that I'm sure many of you have seen us do. Albert, if you're okay, I know you're doing some chart work there. But real quick, folks, another tool in addition to the ones that Albert was showing already would be the profit loss calculator. What I've done here is actually look to add a simulated position. So if you're looking to do any strategies, but I've got the buy right already loaded up, buy 100 shares at least at the time, what was the going rate, sell a call against it August 16th at 135, collecting about a dollar, 95 or so. The net result would be about 116.50. That's that break even we talked about. And then you click apply. There's already some simulated positions down below. If you then are taking a look, what this will do is give us somewhat of a similar look and feel to what we had seen in our example on the slides that we were taking a look at. And the beauty is, if you kind of expand this over here on the left, you can see the hypothetical changes to not only the shares themselves, the 100 shares that you had purchased and their kind of gains or losses at that point in time, but also the option. So if this position, let's say, was to pop up to, just say 122, maybe $4 or so, well, here and now today, what are our profits and losses looking like? Well, all things equal, if you had just bought the shares, you were up 355. If you package this together, well, your calls are going to be slightly lower, but the deltas are still pretty minimal on that. 28 right now, even after that 4-point move. So this position, should it continue moving higher and higher and higher, the expectation is that these deltas would be kind of increasing, negating some of what your underlying shares are making you. But if that was your profit target, then you're kind of okay with that. Even if the cost of buying these to close is increasing, you're a happy camper because the closer and closer it's getting to 135 towards that expiration is going to be better for you. And that's the other change. In addition to the price target, we just modeled what would happen if that took place over today. Well, what if it gets up to 122, but takes a week or takes a couple weeks? Well, if it took a week to do that, your shares, once again, no time decay on shares that you're holding, they're still up that 355. But now look at what happened to that short call. Now it's only kind of negating $5-6 worth of that earnings potential. So there you hopefully see that there is going to be a balancing act for how far out in not just strike prices you want to go, but also expirations. If that was to take another week, now some of that time decay is actually working in your favor for that short call that you had. And that's kind of this balancing act that you want to be able to model, is to say, okay, if we get let's say we get back what we lost today, $125 price point on NVIDIA, and it takes till the end of this month to happen, talking a couple weeks. Well, now I've got stock position working in my favor, and the option that I sold against it's kind of breaking even. And then, of course, that's the scenario if it's working in our favor. I think this will also excel in no surprises if it works against you. Let's say that it drifts from 118 down to 115, and you're thinking, you know what, I needed to manage maybe at a certain point in time. Well, stock position going against you. Now your stock's down about that same amount we looked at initially, down about 345. But oh, hey, by the way, that call that you had sold is nearly at a max gain, making $160 just about of that 195 initial credit you got in there for. So benefit here would be, anybody want to take a loss? Well, no, but does anybody want to take maybe a manageable loss? And that is sometimes the key, is that if you're able to go ahead and package together a credit in order to cushion some of that, I guess, decline in stock price to the point where maybe you're able to award yourself a graceful exit, that might award you a little bit longer to stay in a position for your trade thesis to pan out. I know this was really about the wheel, so kind of going back and forth. But if you're just looking at it from a technical perspective, I know you were looking at it a little bit closer term. Back to even just the quick example I had, maybe your trade thesis was for it to be able to, kind of roughly hold this support shelf that we have seen, but your trade thesis gets invalidated if you are below that. You need to go ahead and actually close the position. If it's sub, call it 116 or so, ballpark figures, folks, maybe that's when you need to manage. Well, we just saw that being able to sell that covered call, giving up some of that upside potential, might award you the ability to actually go ahead and offset some of those potential losses should that directional trade thesis not come to fruition. And then, of course, as we had just seen, if it does, and maybe it's able to go ahead and claw back some of those losses that we'd observed just a few days ago and actually start to approach, whether it's today, tomorrow, or next week, next month, drift back higher up to maybe the mid 120s or even 130s or so. Well, depending on how quickly that works out, then as you can try to model out, the option itself might not be hurting you too much, whereas the kind of anchor of your position is those long shares that you've got. As you can see, if it does work its way back up to what we say about 122, 125 or so, maybe losing out a little bit on those short calls, but then once again, the stock position is really what you're after. So don't lose sight of that. Stock position is really going to make or break this type of strategy. And hopefully this type of tool and you being able to get comfortable and confident, kind of having these directional views, the time frame views, and then we didn't even really get into volatility much at all, but expressing your views on volatility might come in handy. But make no mistake, whether it's a covered call and you already own those shares, or a short put and you're maybe on the hook to be a buyer of those shares, that's what's really going to drive these profits and losses. And the big point of emphasis is, the wider apart or farther it gets from that neutral to slightly bullish, is when this type of strategy is not really going to excel, and maybe when you need to actually go ahead and kick into play your risk management protocols. All right, Albert, that took us 2 minutes past. I apologize, good sir. If you had some closing thoughts, feel free to share, or any other examples. I know Shant was asking a question which was a little bit out of the scope of this, I guess, session, but I mean, we've got all sorts of option sessions, right? So I'd encourage you to take a look at our calendar, Shant, for what we have coming up. If you are looking at maybe buying calls instead, as a means to express your viewpoint to be bullish, that's certainly a way to do that. If you're looking to maybe go further out in time by a leap, where maybe that time decay on a day over day basis isn't as much of a headwind that you're facing as a options buyer, then I would definitely take a look at the other sessions that we've got coming up that cater more towards the kind of buying of option strategies, especially geared more towards the longer term aspect. And Michael, yeah, hopefully NVIDIA helped once again. One of those names I'm sure you're seeing quite a bit, but whether it's NVIDIA, Microsoft, or insert symbol here, use these tools and you express your views on price or different scenarios. Know what winning looks like and what success looks like and how you would manage when the time comes, but then also know what failure looks like and when you need to manage and be able to maybe take that manageable loss, looking for other opportunities elsewhere.
Yeah, I think that's the key, right? Is making sure that regardless of what strategy we're using, we have those risk parameters in place and we stick to them. And folks, keep in mind, this is the wheel strategy. Simple on the surface, right? Selling a cash covered put, selling a covered call. Not simple in the execution, right? Think about just in general what you're trying to do. You're trying to basically pick a point in the future that you want to buy the stock, and you're hoping that it goes to that level and kind of stays there at expiration, not go further. Certainly, you can think of many scenarios where it gets to a resistance or a support level and then blows right through it. So again, simple in concept, not as simple to execute, but certainly there are instances where this will be the right tool for the job. And typically those are kind of range bound type of securities. So again, the goal was not for Peter and I to say, "Hey, go out and start doing the wheel strategy." That was not the goal. The goal was to give you the understanding of how that strategy works. And when you see a spot to use it, then maybe you'll be comfortable using it because there will be opportunities that will present themselves where this would be a strategy that would be a useful strategy for you in your trading plan. So again, hopefully you learned something out today and you got something out of this. Always fun to talk about options, so I'm happy to be here. Peter, always great to share the screen with you. I hope everyone has a great rest of their day, great rest of their week, and we'll see you next time. Take care, everybody.
Absolutely. Take care.